Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Be sure to check out all of our content that we push out into the universe. Best place to do that is to follow me on Twitter at @FocusedCompound. If you're watching us on YouTube right now, you can go to FocusCompound.com to get access to investment write-ups from Geoff going all the way back to 2005. And of course, if you're interested in learning about our money management services, you can reach out to me directly at andrew@FocusCompounding.com. So Geoff, for the record, today is Tuesday, June 20th. And I wanted to bring our listeners to our conversation last Friday before we jump into the topic today, when we were talking about the biggest movie flops in the history of movies. And I asked you if you were going to see The Flash and Elemental this weekend. And you had said that you were going to. I'm not sure if you saw them, but these were both two movies that had huge production budgets.
Right.
The Flash was a Warner Brothers movie, and Elemental was a Pixar movie. I think we're talking $200 million in production. Is that correct for these two movies? And The Flash disappointed over the weekend. According to the numbers, 55 million is what it brought in. Expectations were 75 to 85 million. And then Elemental, I don't know what the expectation was, but 29.6 million according to the numbers. And on a production budget of 200 million or whatever it was, that's considered a flop for Disney, Pixar. So I'm just curious to hear your thoughts if you saw both of these films, and we could talk a little bit about it. Just because we follow the movie industry, we talk a lot about it. And just, we talked about privately on Friday, and then I think on the podcast too, that this summer is going to be a slower movie slate. So I'm sure, we're going to hear, movie theaters aren't, the narrative. It'll be interesting to follow that. When really movie theaters, it seems like this year, it depends on the movie. There are some movies that have done completely well, and then you have these two flops. And there was some controversy behind, I think, both of these movies. So just curious to hear if you saw the movie, what your thoughts are, and just your general takeaways.
I saw The Flash, and I'm going to see Elemental after this recording, the same day of the recording. So they both underperformed. Like you said, they underperformed estimates from the numbers, which estimates it for that weekend. And they were already kind of low estimates for those two movies. The big issues are, one, this is the most competition, that you open two big movies at the same time against each other. And then the brands, right? So we talked about this off the podcast. But I said, The Flash would be questionable how it would do. It probably would be a very good movie because of how they moved their release schedule and stuff. Just suggests that they had very high faith in it as the studio, as like they must have seen previews and things for it for a long time of early cuts of it and wanted to do it because, like you said, there's some controversy and stuff, and the fact that they moved other things and didn't do stuff that usually means that they had, they thought that the product would be good. But they basically kind of had announced things that they were going to change the future for DC movies, which probably reduces interest in it. And then you have just had weaker results for superhero movies. DC, Marvel is what I mean, basically. Movies in those two universes. Pixar's problem is they released a lot of things on Disney+. So we've talked, I don't know that we talked about that on the podcast, but basically there's a question of whether that brand will continue to exist in the same way and stuff. It's at risk. I don't think it's really premium versus, like DreamWorks or something like that anymore, because they did a better job probably of releasing them in theaters and everything. So I think that Disney Animation and Disney Plus, both those things together kind of has harmed Pixar a lot, because Disney Animation has had more successes, and though it had a big failure in Strange World last year, and that combined with putting things on Disney Plus is a problem, right? A lot more people probably watch things on Disney Plus than would watch things on like Peacock or wherever they could put something for a DreamWorks or an Illumination movie. So yeah, so it's a pretty standard movie studio, animation studio now, where it used to be very premium. We'll see, but I mean, even without adjusting for inflation, this will probably be their worst result in 20 years. It's basically the worst.
Yeah, 3
ever.
decades is what I was reading.
Yeah. I mean, basically since the studio started. So, and if you adjust for inflation, even worse than that. But it's not a surprise that way, that could happen. They'd had some weak ones before, and then it opened against really tough competition. Normally you wouldn't open a all ages kind of superhero movie, that could be taking some of the same people. It's probably a weaker brand also with kids, so it probably Pixar draws more older than some other ones. So there's significant overlap, I bet, between The Flash and Elemental. So both of them could hold better than a lot of movies do, but we'll see if that's true. Because for their performance is bad for movies with as high like audience ratings and things as they're likely to have.
Why do you think that they decided to release these two films up against, more of a competitive release when the summer seems to be more slow? They just could have waited a few weeks.
I don't know. It would have been logical to release a week from now instead, but I don't know that it has a huge effect. There's a reason why you wouldn't move it. I guess I don't know. I mean, we talked about, I think Indiana Jones would probably be. So it would make sense to release it a week from now, from when they did. But I don't know exactly why they didn't do that. But you could be concerned that you'd run up against Indiana Jones stuff. But that's a very delayed sequel. It's been a long time since the fourth one, and the fourth one was a huge time since the third one. It's questionable whether that'll be a big success or not. I don't know why you'd be more afraid of that than The Flash or than Elemental or something. So, like we said, but there's some days where they do that. I mean, I think when if you look at the schedule, there's two movies that are both big question marks whether they'll be a success or not, but either one could be. Barbie and Oppenheimer, they're opening at the same time. Those don't overlap much, and I don't think you're going to have a lot of people who want to see Barbie who also want to see Oppenheimer. But there's plenty of weekends that are more open, and neither one chose to take those weekends that are more open. So what you were saying is basically since Super Mario a few months ago to now, it's been jam-packed with a lot of big movies. It will then be empty in a few weeks. There is Indiana Jones, which is kind of the end of the summer, basically. So by July and August won't really be much of a summer this year. And this has been true since COVID. There is Mission Impossible. There's some other things, but they're sporadic. Like I said, for new properties, Barbie and Oppenheimer are the most likely to. They could be a success, could not, depending on whether people like the vibe from them. But generally, the summer ends really fast. But that was an issue since COVID started, and I think it's a lack of product. So
did you like the Flash movie?
I don't. I think. Let me put it this way. It's definitely not it's not performing badly because of the movie. Yeah. But that's pretty typical.
The reviews seem to be good. Like I was people that have watched it. Everyone seemed to generally like it. Everyone's like, "Wow, this is actually a really good movie."
Yeah, but having a really good movie doesn't mean you'll make a lot of money necessarily, because one reason that we have talked about is what comes before it is really important in determining whether people will go out opening weekend this time. So generally, if the truth is that if Elemental or Flash don't do well, There can be a few reasons for that. One is, they don't like the stars and stuff, but that's not usually that important a factor, in modern movies, in the U.S. at least. The other ones, they don't like the concept, right? So cowboys and aliens or something, probably not going to do well just because they don't want to see cowboys and aliens do anything. Westerns don't do well and stuff. So you can have things like that, or it can be like the brand. So if you're saying is the DC brand, is the Pixar brand not what it used to be? Absolutely. But that's not news. Like, those brands aren't what they used to be. You could see that with, we talked about Illumination stuff in Super Mario. The movies that or Despicable Me or any of those, financially Pixar is not a bigger brand anymore than like an Illumination or something. And
why do you think that is?
Streaming mostly. I mean, I think there could be other factors, but I think there's a huge danger with something like animation that releasing, and superhero too. I mean, there's a lot of superhero TV. You have to be very careful about not doing too much of it and not putting it available at home and in theaters at the same time, because then it confuses people about the quality of what you're seeing and everything. So that's just a very big risk. We've talked about those different brands, but there's always talk, say James Bond or something, shouldn't they do a streaming series or something? It's very dangerous because it could be a big success and everything, but it's very easy to harm the brand if you have a brand that's only been in movie theaters for 60 years or something. So it happens all the time, but I mean, the biggest reason you don't have a Star Trek movie right now is because it just got to cost too much and they'd have to recast things and stuff. But the second biggest reason is just that the company that owned it wanted to put out a lot of TV for streaming. And I don't know that you're going to have like 4 series running at the same time that are TV quality stuff at the same time that you're trying to do movies, and you run into that. And so when you get into characters like the Flash and stuff, these are things that were widely available on TV. It's different, they all run into that problem because they want to use some stuff that's Batman related, Superman related, Flash related. Warner has a much bigger TV operation, obviously, than Disney had usually. So they made a lot of things for other networks and their own network. And you want to be careful about that. So I think mostly it's those issues, but it's also, with any of these, you also have to wonder if some of the characters are not as well liked and stuff. I think if they'd done a Flash solo movie before doing any of the team up movies, it would have done a lot better. But I don't think that's a surprise to them either, because I don't think the Flash character was well liked in the other movies, and I don't think the other movies were that well liked either. So, but that's how they do some of them. So if they'd done it the way that they've done some other things in the past, but that's something that they do because the danger is otherwise a solo movie like this might not do that well. So that's why sometimes you prefer to start them in a team thing and then try to split it off if there's interest in the character or whatever. But I also don't know that the drop off is more severe than the drop off we've seen in Marvel movies recently. If you kind of estimate what was a Marvel movie doing before, what's it doing now, I don't know that it's that big for The Flash. And it's not a big failure as compared to some other movies that DC put out. I mean, DC, they scrapped a movie, and Suicide Squad did worse. So this did better financially for them than not releasing the movie at all, and it did better than that movie did. It will do better because it won't drop as much, I don't think.
Do you have any thoughts on 2024's movie release slate? Lord of the Rings. I was shocked to learn that they recorded each movie right after each other. So they recorded, like when they did the first Lord of the Rings, they recorded whatever it was. It was a trilogy, right?
Yeah,
all
the
three
first
of
ones.
them.
Yeah, that's how they did it.
Right after each other. I was shocked when you told me that last week. But do you have any general thoughts on 2024 for the movie industry?
Yeah, 2024 schedule looks much, much stronger.
Yeah.
Much
and that's
more.
as we know it today, right?
Yeah, much more spread out throughout the year. The thing that's going to happen, which we talked about, was that from Mario till now, people are saying like, oh, movies are back or movies aren't back. Like, you can go to the numbers.com because I think that's a really good one to see their models, and predicting it in percentages is really easy for someone to understand. A huge factor is what comes out that week. So we've had many, many weeks in a row. Like, this week is no lower than the week before in terms of what tickets were sold, attendance and stuff. It's just that people say it's weak because there was better product out, and yet the sales were the same, right? What will happen is not that the theater's necessarily weaker market during the summer, but there will not be as good product. There'll be less of it. And that is a factor. I mean, I know the stocks, we talked about this with Cinemark at one time. I was surprised how the stocks seemed to react in, was it 2021 to 2022? That they did react sort of in line, rising and falling. Let's see where it was in there. That it did seem to react a lot in terms of box office results, even in cases where we could predict it. So if you look, the easiest thing would be like where the releases were really weak was last year in the summer portion, the actual, seasonal summer, we had very weak movies, very weak just in terms of like not many releases from major studios. And that's because they put them at other times of the year. And then
the stock fell like 50%.
Yeah. And it could be coincidental and stuff, but I think that's, could be because of like the results that they have and just things that get covered in the press and everything, as opposed to, it makes more sense to look at the sort of what projections are for what it should look like versus how they do. And so the box office has been strong for many of the last few weeks, for a couple months now, but actually I would say it's below projections of what I would have projected for those, with the exception of Super Mario. So, whereas last fall, I don't think it was that good. Maybe last fall. I think last fall, well, is that what I'm thinking of? I'm not sure. There was a period where it was not very strong, but actually each individual movie was coming in stronger than I would have expected. It's just that they weren't releasing very, movies that a lot of people would go to. So something like that estimates is more useful, Yeah, well, a good example would be last year when Avatar sequel came out. People said the box office for that wasn't that strong. It was actually really good by model projections and stuff, and really good versus what I would say it was going to do or whatever. It's just a movie like that doesn't open very big ever. It just runs for a really long time. And so sometimes those, the articles mess that stuff up. We talked about that with the James Bond movie came out, just because I watched those. There were lots of articles, it's going to do some huge number or something. It was never going to do a huge number. That's a misreading of it because, it gets very big preview numbers, because when you have something like that, you get a lot of people who come on the first Thursday, and it did what they were expecting or a little bit better for the opening for that. So a site like the numbers.com or something is good for seeing, the models for each week.
Do you still think Cinemark has the potential to get back to its pre-pandemic highs, which at $17 today would be a little bit more than doubling the stock price? It looked like it, was around 38, a little bit above that, 40, 44, in that area for, 6 years before 2020.
I don't know. That's pretty expensive what it got up to. And it's a very high operating leverage business. I think you may have lower levels of employees, definitely lower hours. We've talked about that. You might have fewer screens and some things. But you just right now you have big issues with that. So I think those are the two biggest problems. You would need someone to give you a high enough multiple, and you would also need your earnings to be pretty strong on lower actual attendance levels. So, you know, I don't know about that, but I do, some of it is, like, and then whether other things will adjust as much too. But I think most of the things they can adjust aren't that easy to do. So they mostly have not great versus like their operating expenses. But yeah, I could see it having more trouble than you might think that way. But, who knows? It's a very tight labor market and all that stuff. It's not been a great thing for these movie theaters for what's been happening. Because like they didn't raise prices as quickly as other businesses, right? So there's been a lot of inflation, but their expenses do rise that way. So I don't know. If a lot of people go back to the movies and we have a severe recession at the same time or something, they might gain a lot of ground versus other kinds of businesses. But in this current environment, it's not that good for them relative to other businesses, right? So like we talked about semiconductors or something, it don't look very good versus that because they have increased prices, but they've actually increased prices less than they had been really before COVID and stuff, and certainly in real terms, way less. And then their own expenses have gone up because they need things like labor, and that's very, very tight.
Got it. Cool. Well, in today's podcast, we are going to revisit 8 stocks that we had profiled on the podcast in 2020. These were 8 overlooked bank stocks. And I thought it would be a good time to rebring these up just because obviously everything that has happened in the banking industry this year. Currently, KRE, the regional bank ETF, is down 26% year to date. So I thought it would be good to rebring up these 8 stocks that we had spoken about. I believe it was in September of 2020, and do a quick recap on that and then see what they look like today. So the first stock that we went over, Axos Financial, ticker AX. It's currently trading at $40, Geoff, and you thought it was a good buy at $23 per share. The price to book when we spoke about the company was 1.1 times. As you can see on the screen today, it is 1.3 times. Used to be Bank of Internet, I believe, was this company. But yeah, you liked the bank, or at least you spoke. You didn't. You just you liked. You thought it was a good enough bank to buy back in 2020. So you've gotten a little bit multiple expansion, not too much. Most of the growth in the stock has come from, as you can see, they've had some good EPS growth since 2020. Any general thoughts on Axos? It has about doubled since we spoke about this bank back in 2020.
It's a thrift, basically. Loans to deposits, like it shows in QuickFS, are over 100%. So probably just that it doesn't have securities is why people like the bank versus other banks, because the mark-to-market thing has been the big concern. Like if you go to different, I'm sure on Twitter they have this, but certainly like Value Investors Club or whatever, they did lots of short write-ups about it about other banks, not about Axos, that basically just boil down to finding whichever banks have similarities to Silicon Valley Bank and First Republic and others like that, and shorting them, So there's definitely been a real focus on that. We've talked about how there's been a lack of discussion with like repricing of deposits and loans at banks. So I don't think people realize that some are much better off that way than others, that a lot of their balance sheet would reprice within a year or something. And then you have others that wouldn't reprice for many, many years potentially. It just isn't a focus. So I think especially ones that have securities instead of loans get shorted and disliked and everything now. And then somewhat on the deposit side, the banks that rely more on higher interest deposits and stuff, the market likes more than banks that have high non-interest and things like that. So, I think that's probably why you see results you do. Because even if you don't have any sort of contraction in the multiple, obviously with what happened in the news, you would expect a pretty big contraction. That didn't happen. So it's probably held up well versus other bank stocks.
Yeah, and the reason I wanted to bring this back up is because bank stocks have done well since 2020, generally as a group. And as I said, most of them have pulled back this year. So if you're watching on the screen right here, Axos was around $55, $56 per share. And where we are right now is at about $40 per share. So I thought, well, we like to find these situations where sometimes it's good to buy stocks that are trading off of their all-time high or off their 52-week high or whatever it is. In this case, this looks like it's off of its all-time high because it's true. I mean, good companies generally trade, give or take 20 or 30% away from their all-time highs, and that could be a good time to, buy into it. So, Axos Financial was a company that we spoke about, and you're right. The multiple isn't too dramatically different, but it was at around $60 per share.
It's incredibly cheap versus other kinds of businesses, obviously. I don't necessarily love this company, and there's reasons for that. But it is incredibly cheap versus other kinds of businesses that have similar characteristics. So if you were not a bank and you had a 17% return on equity and were growing 20% a year for 10 years or more, every year your earnings per share are higher, your return on equity almost never dropping from what it was before, you wouldn't trade at 8-9 times earnings. Its multiple, like we said, hasn't really gone up, but it's been low for a long time, and that's what's typical sometimes of certain kinds of bank stocks. This one, there's always been more doubt about, I think, than some other kinds of bank stocks, but the obviously, the price to book and stuff is quite low for something with net interest margins as wide as this. Because if you think kind of 10 times leverage or something and wide net interest margins, this has been, 4% at times. Almost always 4%. You would just expect a much, much higher price. So I mean, I think although the stock performance is good, in a way, if you look overall at the multiple versus the performance of the business, the market is super skeptical of this company, right? Because why do you have something that's compounding EPS really high all the time and yet doesn't get high PE ratios?
Do you think Buffett thinks about banks, the same way, thinking like this company should trade more in line with other companies, like at multiples that, for example, this should trade at least at a market multiple, even though this probably from a quantitative perspective looks a lot better than a lot of companies in, the market, for example. I mean, do you think he thinks about it like that? Or do you think he just like, oh, it's a bank, so it's always going to trade at a discount to other companies?
No, there's no evidence that I could see that Buffett has ever thought about businesses in different industries should trade at some level because the market puts it there or something. He doesn't look at what the market says the value of something is. He looks at what, he thinks it will return in the future and what that's worth. That's why sometimes he goes into things like energy or something, because he thinks it's more attractive versus other choices there. So no, he never says things like that. He doesn't use comparables and stuff like that. In a sense, they're all DCF calculations with how he's thinking.
Got it. Yeah. So that basically doubled, and that's off of the stock being down from close to $60 since we spoke about it. And that was a good stock at the time. Next one that we went over, Bank Financial Corporation, ticker BFIN. It's currently trading at $7.79. We talked about the stock when it was at $7.29. So we're basically in the same area. Price to book in 2020 was 0.6 times. As you can see on the screen today, price to book is still 0.6 times. Let's see what your thoughts were. Jeff's thoughts. They haven't grown and haven't had a ton of success. You had mentioned that the only reason you were bringing it up is because it was trading at 2/3 of book value. And you thought that perhaps it was something that a different bank could buy, basically buy all of that, change their lending, change what they're doing, and merge them into their own operation. So it sounds like somebody could basically pay a premium for this company, for this bank, and still purchase it under book value. So that's the only reason that you had brought this stock up. You really didn't give it credit for anything other than the fact that it was trading at 2/3 of book value.
Yeah, and looking at it, it looks like it has a poor long-term performance, obviously, and it looks pretty much the same as what we talked about it before. I think that that's true. There's some things I don't know enough about the bank to know why the reserves are exactly where they are and everything, but most other things except for the reserves and a little bit the leverage stuff that you see there. But we'd have to look at the balance sheet to know exactly what things are marked in what ways. But that there's nothing unusual that I see there. Those are the only two things that stand out to me is that the reserves are quite low for a bank doing general stuff, and that their leverage went up a little bit.
We could pull up their most recent balance sheet if you want to take a quick glance at it. Yeah, you had said that this just reminds you of sort of a typical bank that you see in, it's an Illinois bank, and there wasn't really anything too special about it. Just remind you of many other banks.
Yeah, the performance is very bad compared to your average bank, the long-term performance. So that is different. But it does have some things that are, also the growth is incredibly flat. I guess it did grow a bit in COVID and then came back down in some ways. So that's maybe the only thing that we're seeing there. But coming out of the financial crisis, it had negative retained earnings, which would be unusual for a bank. I don't know if all the things that we're seeing in Quick FS are that accurate for some of the things, like how we would have to break it down, but it still looks like something that someone might acquire. More so, it seems likely that it would be acquired and put to better use than that would have success on its own, I guess. It doesn't really have much more in the way of loans or deposits than it did even 10 years ago. There's some big changes that you can see in Quick FS in the COVID period and right after, and I don't understand those without looking at like the call report and stuff. So basically what happens is the cash goes up a lot during COVID. That's expected. But then it moves into securities and loans after that. It's possible the reserves are low, but I don't know. If you look on average, the percent that's been reserved for loans is actually, so like they have 20% more gross loans than they did 10 years ago, and yet they're down more than 50% on loan loss reserves. But if it does look like the bank may have improved more than I thought since the financial crisis, and the situation could have been worse in the financial crisis than we know because we didn't go back and look at all that. So it might make more sense than I think that the loan loss reserves are so low and the way that it's developed over time, because maybe they were slowly absorbing problems that had been a problem for the bank for a very long time. In fact, until the last 10 years, they weren't even consistently making money at this bank. That's very unusual. So maybe this bank was really in bad shape coming into this last decade, and maybe it's improved more than I thought. Yeah.
They've bought back a lot of stock over the past 10 years. So in 2013, 20 million shares outstanding. Today, we're at 13 million.
Yeah. That is a lot of buying back of stock. But you still are dealing with I'd have to check what the peak. They've never earned 10% or more return on equity in 2 consecutive years. So net interest margin and loan loss reserves are pretty typical of the kind of thing that we're talking about, where we're talking about Axos and like thrifts and stuff. I could see having a net interest margin low 3%, high 2%. and loan loss reserves in the 0.7%, kind of range or something. That's not that weird. It is, I guess, a fairly small bank, and I think my memory is it has per branch, it might have quite low stuff. Yeah. I don't know what the issues are, but it seems like some sort of expense efficiency issues. That could be insufficient scale, could be the way the bank was run or whatever, could be the biggest problems now. There must have been problems with losses and stuff going back into the 2000 to 2012 period and actually making bad loans or something, but that's not the problems in the last 10 years. It's just being able to generate a high enough return on equity. But like we said, 2/3 of book value or whatever, you actually could get a perfectly fine return with the returns on equity that they've hit before, right? So if the return on equity is only 6-7%, then that's like getting a 10% type return on your money if you buy into the bank. And then, of course, some other bank might be able to acquire it and improve things. So you would think that its results could be good, based on that. So that's why buying at a discount to book can be attractive. Yeah.
We've talked a lot about purchasing these premium books and being able to pay a premium to book value for a great bank with a great culture, great, expense management, stuff like that. Have you ever purchased a bank solely because it's, trading at 2/3 of book value and more so you just think it's cheap as opposed to, paying up for a great bank?
Yeah. And not solely, though. I mean, the situation is similar to where we talk about Virtu Motors, right? So, yeah, I would compare a bank, an insurance company, a car dealer all the same way on that. I'd be very happy to buy them at 2/3 of book value or even, less than tangible book or something if other things were fine with what they were doing. So here we saw that they were buying back stock. Again, I don't know all the details because looking at it, but it doesn't seem like they've had problems with asset quality in the past, but you'd have to look at it to understand it better. But if the improvements are mostly positive in the last 10 years, and yet there was no growth, it may be because the counties they're in and stuff don't have a lot of growth. It could be competition reasons, whatever, but it's not a big deal if they're paying it all out to you in dividends or buybacks. It doesn't really matter. And then, like I said, if someone else buys it, it'll probably be done at a higher multiple. The same as with insurance things, banks and small insurance things, small banks, small car dealers, it is worth more to someone else. Or we talked about lime and cement and everything. It's worth more to an acquirer than it is on its own, because obviously it's hard for an acquirer to come in and take share from you. So if you're trading at less than what it would cost them to replace it on their own, then, and book value is a good guess for banks, then it would just make sense that they could earn higher returns through scale by doing it. And if they wanted to go into those places, it would make more sense than opening their own branches in many cases. So, yeah, I mean, I think that generally, like on average, that's the best way to buy banks. Like the best way to buy insurance companies and stuff is on average, if you're going to do a lot of buying of these things, you would want to look at what's the best businesses at some discount. I wouldn't necessarily go for the ones that have the deepest discount, but let's say 2/3. 2/3 is a good guess. Look at all the banks that are 2/3 of tangible book or less, and then buy the best ones, or the safest ones, or the most durable ones, the ones with the best management, or whatever things that make you feel the most safe about it. I wouldn't say let's look at the ones that have the biggest discount, just a sufficient discount. And it's somewhere probably in the 2/3 to 1 times tangible book value range.
Do you think Jamie Dimon has purchased more banks using that framework or more banks that are just completely in the distressed situation where it's, they're picking it up for pennies on the dollar?
Yeah, I don't know how good the decisions to make the acquisitions of distressed banks have been for JP Morgan, or whether it really helped them, or whether they should have done it from the company's perspective. Certainly with when he worked with building up what became Citigroup and everything, it's multiple arbitrage in that they're often distressed or there's something that people don't like about them, but it's that your multiple is higher than their multiple. I mean, the best way to build up a bank that way is to try to issue stock in your bank that trades at a high price to book and acquire it at one that trades to a low price to book. If you can't do that, then use cash or something else. So yeah, I think that's generally the way to do it. The distress thing, I don't know, because, like I said, I'm not sure if that's really helped them as much. Does it help as much as buying back your own stock, paying out dividends, acquiring things, or building up businesses of your own? I don't know. It gets a lot of press and stuff, but I don't think that that's a big part of success for any of those companies. And lots of banks that have been very successful don't do acquisitions, or they do acquisitions all the time, which aren't of distressed companies. Those are the two actually most common ones I can think of, is banks that have had a great deal of success with no acquisitions, and banks that do acquisitions all the time, but the acquired companies aren't distressed because they need to keep buying them all the time.
Mm-hmm. Next bank stock that we spoke about, Banner Corporation. It's currently trading at $46 per share. We profiled it at $31.65 per share. Price to book in 2020 was 0.7. As you can see today, price to book is 1 times. What were your thoughts on it? Your thoughts were you thought it looked fairly normal for a 10% earnings yield. You thought it was slightly cheap. It didn't strike you as an absolutely great bank, but again, it just was a typical bank in your eyes in 2020. Let's see what.
Do you remember when we did the podcast in 2020?
September.
Okay.
Yeah, September of 2020. So this stock as well looks like it was, if you go to, let's see, a 2-year chart before this year, it was almost double higher, $75 per share. And yeah, so that has sold off as well with all of this stuff going on. But yeah, return on equity looks, kind of mediocre, I guess. 10-year median return is 9.2, but you take out '08 and it's been a little bit higher, but they got hurt through '08. So I don't know if you would exactly like this company. If same management was there, you'd probably want to look more into that.
Yeah, it's a Washington bank, I think, and probably there weren't a lot of banks in Washington that didn't do badly in the financial crisis. I think that's right. Let's see there. Yeah, Washington. They have very low asset leverage. So generally to be honest, I would only, it depends on if there's something weird going on with the bank, but I don't think, although we talk about return on equity because it's easy to do the calculations with price to book return on equity, people think about it. I would really only look at return on assets. Even outside of banking and stuff, I don't know why you need to use return on equity instead of return on assets. I think statistically return on assets is probably capturing most of what's return on equity. And then especially with banking, obviously then you don't affect the leverage stuff. This operates with lower leverage, and it has fairly, compared to some of the banks we looked at before, it has somewhat higher loan loss reserves and somewhat lower leverage, operating more at 8 times normally than at 10 times. So I think that is going to be maybe a little bit more attractive to an acquirer when you have those things, or to running the bank a different way or something. So just to keep that in mind. The same kinds of earnings, but achieved with lower leverage and with higher reserves and stuff would obviously be better. But they could be making totally different kinds of loans and stuff. So we don't know that without looking into the details of it. Obviously, bad things happen in the financial crisis. So that's a concern.
Is that something that stands out to you? Is that they are using less leverage and they are able to generate a over 1% return on assets and a 4.1% net margin? Is that something that kind of in your head you start to think, what type of loans are they making to generate that?
Yeah. What I'm looking at is since 2019 to today, right, what happened. And their leverage went up a bit because it was very low. It was at 7 times. Their loss reserves went up more than what we've seen at other banks generally, big banks and stuff. So that would kind of disguise, it would make their earnings look worse than they were. But like I said, the leverage part did go up, but loans to deposits went down, suggesting that the leverage thing was securities coming in being put into, deposits coming in being put into securities. So it's possible that results are actually more positive since COVID then is captured here, and that if they were a giant bank, they would report it in a way that makes it look better. They seem to have done it. They may be operating less aggressively than some large banks since COVID, I would say. But there could be some reason for that, although I doubt it. I think that that's unlikely. Yeah, because if you look, we can see the huge, at one point a huge contraction, and now it's a bit of a contraction in net interest margin. So the underlying performance of the bank is probably better than it appears in many ways. But you'd have to look at the securities and what they bought. For all I know, they took all the deposits and bought really long-term securities or something, because we know that they got deposits and put it into securities, or I think we know that. Securities before COVID were 1.8 billion and then became 3.9 billion in 2022, though they're down from 2021. Loans are up like less than 5% or something. If they bought really long-term securities that were, we've talked about this a little bit. If they bought things that are just lower yielding, and if their deposits are likely to cost more than the securities that they bought, say like First Republic or something, then that's just bad. But I don't actually worry as much as other people do about having some securities.
Mm-hmm.
I don't really agree with the sorts of things of, like I said, value investors clubs, writeups of shorts and things. Just focus on banks that have a lot of mark-to-market have a lot of securities they have not marked to market, and all of that. I think the most important thing is when your deposits reprice and at what prices they are, and at what your assets reprice and at what prices over a long period of time. In other words, are you going to make a lot of money in the future or not? Silicon Valley was a little bit more of a special situation that way, but First Republic certainly was just a fundamental issue that it isn't just whether the bank would fail or something, but like it would just not have good results for a very long time. Why would anyone want it? So, there's a couple banks that people are very pessimistic on that I'm less so, but they could obviously fail or something if people just decide to pull their money from it. At almost any bank, if 30 or 40% of the people of the deposits were pulled instantaneously, the bank could fail. There's only a couple banks where that's not the case. So, anything that gets written up and that people are negative on that way could be a problem. But I think it's an oversimplification to focus all the time on the securities issue and stuff. It's a more fundamental issue. I think the hot deposits is the more fundamental issue and what you do with it. Fundamentally, Silicon Valley Bank and First Republic and all those had a lot of deposits pour in and had no good use for them. And so they, did things that weren't smart. But it's kind of more that issue, which is more similar to just making bad loans and stuff in the past. Is the same thing, that you have more, and we talked about that, but rapid asset growth and all those sorts of problems that you might have. But in general, if I think that your deposits are going to be cheaper than your loans or securities in the future, then that's great and not a problem. And it's just a question of how long that takes to adjust and stuff. But I've seen ones where people are very negative on the bank, even though we know that there's significant repricing happening in a very short period of time.
What are those banks?
The most extreme example would be probably UMB Financial. Okay. UMB Financial has a very high percentage probably. I want to be careful talking about this because, like I said, the people write short write-ups about it. They say it has similarities to other banks and stuff that have had problems. I think some of that is fairly superficial looking at it. UMB Financial is not a great bank. It's subscale in all the businesses that they're in. It's much more diversified than banks normally are by industry and by the things it does. It does things. We talked about we have a hedge fund and stuff. It does things in that kind of area, which is very unusual for a bank this size. It does things in payment processing things. It does things in more corporate, mid-market, whatever. It's like has a lot of different businesses. It has a private bank part to it. None of these are that big. If you compare them to other banks that are standalone things in each of this, they're not that big. So it's not as good as being like a community bank of the same size or something. That's their problem over the really long term. However, they an issue that people have with it is that it has very high like uninsured deposits, but that can be caused by some of the clients that you have. For instance, if you have larger corporate clients, which they do, and they're particularly large versus them, then the fact that they're less of a real regional bank, a real community bank, is not a very big part of their business. You would have that happening naturally, even if the deposits were very seasoned and stuff. So the two that stand out to me that people worry about, and there's some justification for worrying about in each case, but I think there's very big differences between them and Silicon Valley and First Republic and everything, are Bank of Hawaii and UMB Financial. These are banks that have a lot of uninsured deposits, obviously, but that doesn't necessarily mean that people would leave with those deposits, and they haven't necessarily had huge inflows of deposits relative to like what other banks had, or very rapid asset growth compared to them. UMB Financial has stretched it with that sometimes, though, but much less so Bank of Hawaii. So, like Bank of Hawaii's deposits are pretty good compared to other banks versus exactly what happened in COVID. I mean, they're pretty normal. There's been some growth and everything, but it doesn't show me the same extreme issues that you see at some other banks. Asset growth is much lower. And there's just other things like to be able to operate with that low a net interest margin and yet to have returns on equity that high. Now that's because they use a lot of leverage. Returns on assets are
14 times.
Yeah, returns on assets are more middle of the road, but net interest margin is very low to have a return on asset that high. Obviously, there aren't large banks in Hawaii. The big, too big to fail banks aren't in Hawaii. So you wouldn't have a lot of choices that way. Hawaii's not a very fast growing market. These banks aren't very fast growing. So it's a lot of seasoned business and stuff. So could be a problem and everything. Bank of Hawaii is not the most conservative bank. It's one of the UMB Financial. We did not write up for singular diligence, I think, though we would have done it if we kept doing bank issues. And Bank of Hawaii, we did talk about, but they're two of the least conservative, safest for longest term of banks that we considered. Still, I think there are features to them as banks that make it likely that they might continue to earn decent returns in the future. The one that I mentioned with UMB Financial is that it's quite flexible in terms of what people would be, because of the businesses that they're in, you would expect it to reprice. Because there's two factors there that I think we looked at the loans to deposits and stuff with UMB Financial, but let's estimate that 70 to 75% of their balance sheet is in, it's lower than that. The loans to deposits are actually down at 60 some percent as of last year, but let's say it's 70 or 75%, right? In loans. And then let's say 70 to 75% of those loans are, would adjust within a year or something. They're basically variable. Those aren't bad guesses, and that would mean that 50% of your balance sheet reprices within a year that way. So unless you have a very hard time getting deposits, that doesn't seem bad to me. The ones that you'd worry about more are the long-term purchases that we talked about, really long duration stuff of securities, but also mortgage stuff where it's, one, just impossible to know when it will come back to you. There's mortgage and construction, things like that, and the banks will say how quickly they think it does, but it would depend on the circumstances. If there's a hot market, then you would expect people to be refinancing and going into new deals and whatever all the time, and if it's completely a dead market, then things could stay out way longer than you would expect. Whereas like some other kinds of lending, that's less likely. So anyway, you can look at it. They have presentations and stuff. UMBA is a very, very diversified sub-scale kind of bank. But one concern with UMB, which I point out with a lot of these banks, UMB actually has, over the last 10 years, probably grown its assets faster than its like return on equity is. And if you want to look for banks that are not likely to fail, I would say the safest thing would be like their 2/3 or so of their growth is 2/3 or so of their return on equity, right? So they can pay out a dividend and still be able to grow that way. Something like UMB, what they have to do is they would have to raise capital or something if they're doing that. And obviously having to tap capital markets and stuff would be dangerous for a bank, or just even having to get more marginal deposits all the time. So like we talked about a bank that bought back stock, UMB's increased their share count by, 15 to 20% over 10 years, which is a lot for a bank to do. Bank of Hawaii doesn't have that issue. Their growth has been very low and their return on equity is very high, which is one thing that I would point out. Like I said, there can be a run on a bank, regulators can shut things down, whatever. But if you mean like, would Bank of Hawaii, if allowed to operate, have a problem? No. Because if it just didn't pay a dividend for a little while, didn't buy back stock, look how high the return on equity is and look how low the growth is. They would quickly fill up problems in their balance sheet and just be able to move on. So like severe mismatches, if you just let them go, like we talked with Jacob about Geico and everything, the thing is, if regulators let Geico go on the basis that they were going to make a bunch of money and not pay out the capital for a couple of years, they quickly fill up the hole in the balance sheet. We talked about another bank that has almost never had returns much better than 6% a year, return on equity. Okay, that's a problem. The European banks a lot of them have that problem. If they get into a bad capital situation, how do you ever solve it? How do you grow out of it and everything? Right? Because how are you going to raise? You're going to raise capital from people. You're going to do it in some way where you have to pay them interest or pay them, or be willing to redeem things and stuff over time. You're usually not by doing it with common stock. And how are you going to get that in some form that isn't like we have to pay you big dividends and stuff? So a bank that usually buys back its own stock instead of paying a big dividend, and that has a very high return on equity and a very low rate of growth, is usually going to be safer. So, yeah.
For people listening, the 10-year CAGR on earning assets is 5.7%, and the 10-year median returns for return on equity is 15.6%. So that's that difference that Geoff is talking about, 5.7% in earning assets growth over the past 10 years, and you have a 15.6% return on equity during that time. So much more safe, I guess, is what you're saying. They haven't had to tap external markets for that growth. So other than the leverage, right, 14 times levered, what are people worried about with Bank of Hawaii? Is it purely because the Hawaiian market and stuff like that? I mean, I feel like that comes up kind of often with this company in that area. Maybe? No? What are your thoughts?
The Hawaii market comes up often. I think one is you would have very high levels of uninsured deposits, which is a big thing for any of these banks that people are focusing on, is the uninsured deposits. I should point out, like with very small banks that don't report things and stuff, I've seen banks that have huge amounts of uninsured deposits and I've seen no decline in them. It's also worth mentioning that for the most part that I can see, although the runs on the banks happened at regional sized banks, large regional sized banks generally, but in general that happened. And there's some evidence of concern from things we talked about, Frost, where people are wanting, where some of the most marginal deposits, instead of being treated as deposits, there are like repo stuff. And so that's a concern that just in general, probably people don't want to keep gigantic balances at regional banks and stuff. But for the most part, the too big to fail banks are losing deposits faster than the banks below them in size. I mean, there's definitely no evidence that the regional bank size things are losing deposits faster than the too big to fail type banks. There's more excess deposit stuff at the too big to fail type banks, and there's bigger gaps in terms of what they're paying versus what they should be paying on interest and stuff. So they're not at risk of a sudden run on the bank with people thinking they're going to fail, but they're just very unfavorable in terms of their the stickiness of their deposits and the interest that they pay versus interest that others pay. For the most part, there's some exceptions to that. Like I guess American Express, for instance, would be a too big to fail bank basically, and they would be more competitive on that stuff. But I'm talking JP Morgan, Bank of America, Wells Fargo, Citi. So I think the issues that people would have with some of these banks are, one, it's a regional bank, so it's not a too big to fail bank. Two, I think they would look at things like their accumulated other comprehensive income, which is a very large loss for Bank of Hawaii. You could go quarterly for them and see that. It's on the balance sheet. You should see it under like where you can see retained earnings and things like that in the comprehensive section of it. So they used to not have any of those losses, basically, right? And now they should have a bunch.
Yeah. Mm-hmm.
Yeah.
Yeah.
So how big is the loss that you see there?
Negative $405 million.
Okay, and how big is the balance sheet? Like the total assets?
Total assets about $24 billion.
Okay. So that's the kind of thing that people will be looking at, right? So like in a single quarter or something, how big does that get? Yeah, and then also like I said, the very large uninsured deposits people are concerned about. So UMB, Bank of Hawaii, and all of that. I don't know. They probably put out investor presentations describing it, but I wouldn't be surprised if 50% or something of deposits are normally over the limits there. And that's pretty normal for some of the relationships that they have. I wouldn't be surprised. There's also another Hawaiian bank. There's a couple Hawaiian banks, but there's also another one that people might think is a better one in terms of it doesn't have the same possibility of risks, I guess.
What's that ticker?
Other bank that people might like better than Bank of Hawaii.
Yeah.
There's a few, but I think the one that's likely that people are looking at is probably First Hawaiian. If you want to look at that one, does it have a similar market cap? It's FHB to Bank of Hawaii.
Yeah, so it's $2.4 billion market cap.
Yeah. So I'd have to look, but I wouldn't be surprised if these two banks overall have similar deposit market share and stuff, like reasonably similar in terms of ranking in Hawaii. But that Bank of Hawaii makes more loans than First Hawaiian. Loans to deposits, let's see. No, that looks pretty similar between the two of them. I would think Bank of Hawaii would be more have more CNI type customers, but that could be wrong. Let's see. Their market caps are pretty similar. Loan to deposits are pretty similar. Yeah. We'd have to look at the call reports and stuff to figure all of that out.
The stocks trade pretty close together. I mean, Bank of Hawaii is down negative 46% over the past 2 years, where First Hawaiian is down 33%. But before that, they kind of looks like they traded on like a 2-year chart, kind of in line with each other.
No one picks one and not the other. I mean, I think for the very long term and stuff, if their capital allocation was different stuff, Bank of Hawaii might be better. But they're buying it mostly because of either they like regional bank stocks or not, and also just
it's like a theme,
the economics of the Hawaiian banking business. The leverage is much lower on First Hawaiian. There's also another bank that is within a publicly traded company. It's attached to a utility in Hawaii. So that's another one that people could look at, but it's only part of the business. It's an oligopoly in Hawaii.
Utility called? What's the ticker?
It's the ticker for the other one that I'm talking about. It would be Hawaiian Electric, but the utility is big, so I don't think people should look at that. It'll confuse them.
Got it. HE is the
but it's
stock ticker,
right? But it's very largely utility. It's not just banking. But yes, that is another bank in Hawaii. That's correct. They've talked about spinning it off and stuff before, and that's something that, I mean, if you ever see that written up as a stock or something, it would always be based on the idea that they might split the two things up.
Has the company ever shown any sort of indication, or has that always been speculation?
They were going to do it. I think that they were going to do it because of regulatory things and stuff with trying to close the deal. But my memory is that they failed to sell themselves to a mainland utility. And if they did, then they would have had to split off the bank because obviously another utility company doesn't want to buy a bank. I don't remember the details of that, but I believe that they wanted to merge, like they wanted to be acquired and weren't. I don't know if they've said before that they would spin it off if there wasn't a merger or something.
Think about that. That would be a classic Greenblatt, two different industries type of spinoff. Here you have a utility that is valued completely different than a bank. Like the way that both of those businesses would be valued would just be so different than if they are mashed together. That would be a very interesting situation to follow. I mean, because Hawaiian Electric, I mean, you look at the PE, 18 times, EV to sales, 1.8 times. I mean, what do most utilities trade at on an EV to sales or a PE basis? I mean, premiums, right? Very high usually. And then, you have banks which don't trade as high as utilities. So I don't know. That would just be a very fun situation to follow because it's sort of that classic two different businesses and two completely different industries that are being looked at as if they're sort of one and the same, at least from like a valuation perspective.
Yeah. I think it's mostly priced off the earnings per share and the dividends because I can't imagine that people can really break down the two different businesses and understand them both. I don't think there's many people who invest in both utilities and banks or analysts that would cover both of those things. And even if they did, they wouldn't know anything about Hawaii, presumably. So, I think people probably look at their dividend check and their reported earnings and focus on that.
Yeah, that'd be a good one to follow. Okay, we could go on to the next stock that we had spoke about. First Savings Financial Group is the company. FSFG is the ticker. We talked about the stock when it was at $48 per share. Today it's at $12.37.
Wow.
Price to book was 0.8. Price to book today is 0.5. Let's see. You said the price to book was below 1. You were going off of its history. That's what you thought was interesting, was that return on assets had tripled. You thought that there could have been an improvement on the asset side. Let's see. You said, but you weren't fully sure since loan losses were the same. It said expenses were down while the bank was growing. So it seemed like they were trying to improve their efficiency. If you look here, I wonder what happened. Earnings per share
dropped a lot.
Fell off a cliff. Yeah.
Yeah. They put out a release in, let's see, April of 2023, which says that aggressive measures taken to restructure the mortgage banking segment through expense reductions, efforts to rebuild the small business administration lending segment's lending team, and continue to focus on balance sheet management for the core banking segment, positive results. So we continue to be selective in lending, adversely impacting net interest margin for the quarter, but somewhat protecting from persistently higher interest rates. We are encouraged by the performance of the core banking segment and are optimistic for the SBA and mortgage banking. Well, those things fell off a cliff, obviously. They repurchased some of their stock. They've bought back 5% of their stock in the last 9 months. So that's interesting.
Yeah, we're back to 2020 low levels right here. So let's see if we talked about this stock. What did I say? The stock price, when we looked at it, was around $48 a share.
Yeah, do you want to know what their quarterly efficiency ratio was for the most recent quarter?
60%.
That's a very good guess. It's not right, though.
Is it close?
No, it's not even remotely close. 80%.
Okay. Got it.
So that's pretty amazing. So they got to be making a lot in fees. This bank has to be very, very fee driven. So it must be that fee stuff on the SBA and the mortgage is what drives this bank. Because to understand that, they say they have a 3% net interest margin and 80% efficiency ratio, and yet they had a 0.7% return on average assets. So it's got to be huge amounts of fees because the bank would be losing money if it wasn't the case. So it has to be doing a lot of stuff that is, loan servicing rights and let's see, where they would break that down. So it looks like lending must not be a very important part of this bank, as compared to making money on fees. And especially if it's SBA and mortgage stuff, then a lot of this could be very driven by activity levels and that stuff, which obviously would have gone through the roof during COVID. Did the earnings spike by huge amounts during COVID and then come crashing down?
It did, yeah. So 2019, 16 million, 2020, 33 million, 2021, 30 million, 2022, 15 million, and then TTM, 11 million. So we're actually behind pre-COVID.
Yeah, this is actually a fascinating stock here that we are looking at because it breaks down efficiency ratio by segment for the last 3 months. So this is what's fascinating about it. Now, I don't know if you need a different management or what you need to have happen. You might need some very big changes at this bank because obviously people must have been investing in the stock and everything on the basis of completely different situation than today. But the efficiency ratio, which basically the efficiency ratio is like what we've talked about, combined ratio for an insurer, or we talk about operating ratio for a railroad or airline. You know, we're just talking about taking an expense and relating it to revenues from that thing. So basically, when we're talking about efficiency ratio for banking, we're normally talking about non-interest expense relative to revenues. Now, for a traditional bank, I think it makes more sense to scale it to assets, you know, so which are pretty much similar to deposits. So basically, what's the size of your balance sheet and what's your non-interest expense? But for banks that are getting things from fees, then it could make sense to look at other stuff. So mortgage banking last quarter, their efficiency ratio was 108%. So in other words,
wow.
Yeah. Mm-hmm. So losing money even if you weren't charging interest. Even if you no one ever paid you any interest, you'd still lose money. SBA lending's 97.5%. And by the way, both of those are huge improvements over the previous quarter. And core banking was 69% efficiency ratio, which is a big decline over what it was before. It actually had been okay at times, not great, 50 to 70% in the core banking stuff. But there might be an actual core bank there that's okay. It's not great. If it wasn't for the lending and the mortgage banking. I wouldn't be surprised if we went back a few years if they don't even break it down this way, that the reason for doing this is because of how large the losses are coming in from these SBA and mortgage stuff. But SBA and mortgage stuff would run very hot and cold. You know, it's the problem with investment banks or anything like that. They make a bunch of money in something that's, you know, hot for a while, and then that dries up, and then they have to go into something else. They can't just keep doing the same thing all the time because some of these things wouldn't have much volume, and that could be the issue. So I think this one would be very different to analyze, very differently from a bank that's a spread lender, you know?
Mm-hmm. I don't know. I'm trying to, how do I get to the bottom of this? So I'm looking at the video that we recorded, and the ticker, we have QuickFS up, FSFG, and the last close was $48.31. But I look on OTCM, a stock chart, and it was nowhere near that ever. And then I look at the shares outstanding, and it doesn't look like they did any sort of reverse split or anything like that. So I don't know, or split, whatever. The shares haven't changed, so I don't know where that data is coming from that I'm pulling. I mean, it was what we used from the video, so I don't know what happened there.
Okay, let's see. I can
September
see.
28th, 2020. So, I guess we could just see
regardless,
what
the stock is down by huge amounts. This was an almost $30 stock no matter what way we look at it, right?
Yeah. Mm-hmm. Well, because if I look at OTCM, the stock, it looks like was at like 16 then.
But they don't have any data for it going back to 2020.
OTCM?
Right? Does it? I don't see it. Does it? Let's see. Yeah, it does. Okay, it does.
FSFG, yeah.
There's not much of a difference. It says 30. What did you say the stock was at for that it got to a peak level of?
Well, I'm looking at the screen right now. Watch, I'll pull this over because I just was checking because I was looking at this map, right? So, based on this stop point I have, the last close $48.31 is what the price that I was looking at. So I don't know, maybe.
And this says $30 or something when I look at it on that. But I don't have daily numbers, but it doesn't look like it ever spiked anything like that.
Yeah, that's my point. If I go to 9/28/2020, it says that the high was $19, open $16.19, close $17.68.
Well, does it show the market cap? I mean, these things are very easy. That could be results of splits and things. I don't know that they've ever done anything like that, but obviously you can get confused.
Yeah, that's why I was curious, because I'm looking at the share count on here. So I don't know but who knows? Maybe there was bad data there, but based on, I'm sure the price data was correct on OTCM.
Yeah, probably.
I'm trying to make a case for Geoff that you're not down as much as.
Oh no, this is down a lot.
As it would have been.
Oh,
it's down a lot.
You mean that it went up a lot?
48 to 12.
Okay, yeah. No matter what, the stock is down a huge amount. Yes, from the time we talked about it, it went up by a huge amount. On a stock chart, right? It tripled or whatever, and then it went down to the same level that it's at now.
Yeah. I'm trying to say that we didn't talk about it at $48 and now it's at 12. We probably, based on this price chart, talked about it at $16. It ran to almost 30 and now it's at $12.30. Yeah.
Yeah, maybe it's down 10% or something, but at one point it was more than doubled. I mean, actually, on almost all days except for the last, since the banks started failing, it actually has beaten the S&P from what we can tell. I mean, from the day we talked about it till like First Republic and stuff, it would have been beating the market. You know, Silicon Valley at least closing, it would have beaten the market. So that gives you an idea, but that's not hard to see from looking at the Quick FS because it went up by a huge amount during that time. It seems very difficult to figure out what would be happening. But obviously, if you had ever said we're closing down or selling off or whatever those other businesses and just left the bank, that might be good for people. You can see that core banking is probably very mediocre. Someone I'm sure will do like a pro forma and stuff to break it down to analyze the bank. But I wouldn't be surprised if it's close to what we talked about with, was it bank? Which one was it that we talked about? That I was saying that the returns on equity and stuff probably was it Bank Financial. The core bank part of it looks pretty similar to something like that of one of the ones we talked about before. So. I think that it's the huge increase in stuff is from the SBA and the mortgage stuff, which is very hard to predict what the volumes will be in that. And then I'd worry about the management and all of that and everything. If you're looking at something that it's very hard to manage a business that has that huge growth in some parts of it and is flat or contracting in other parts, and what happened during COVID.
Yeah, the CEO and CFO both sold some stock at $22 or thereabouts. CEO sold $1.1 million.
Has anyone bought stock in it?
A director bought in March.
Yeah, I don't like talking about the insider trading stuff for banks, but it's very, very helpful. Let's just say that. If I've mentioned a bank, maybe you want to go look at whether they've bought or sold. And if I say this bank, this is maybe misunderstood, and this one maybe is well understood, you'll notice all the people are selling in the bank that has more of the problems, and all the people are buying in the bank that doesn't have as much of those problems. And especially when you see things where it's continual buying by a lot of people, even in small amounts and stuff, I think is more significant. You do have some where they probably forced everyone to buy or something. You know, you can see on the day that they like all decided we're all going to buy $100,000 or whatever. And then that's the only time you see it. Like when you see those, it's like everyone bought on the same day and then there was no buying ever again. But if you've seen since things happening in March or whatever, that people just are randomly buying for months, that would be a good thing. For banks, people aren't likely to jump in and buy a lot if they are concerned about what they're seeing with what's happening with deposits and stuff. So I don't know that insider trading is a great indicator, but you probably don't have someone doing a lot of open market buys and stuff if they're worried about the health of the bank. And the main thing is if the stock just drops a lot, that doesn't necessarily mean it's cheap, but you will just see people buy because it dropped a lot. And so what they're saying is the bank is fundamentally just seems fine to me. And so I'm going to buy just because it dropped a lot. I don't really know what it's worth or anything, but I work here and it went down a lot and I don't know what people are reacting to, so I'm going to buy.
There's been some talks that have come out of the whole Silicon Valley Bank debacle where if you're an executive at a bank and it goes under or it has to be bailed out, then those executives should basically have to pay back, bonuses and compensation that they've earned over the past, whatever years you want to use, or basically since they've been at the bank. And I don't know. I think that's kind of I think nobody would go into banking if that were true. And B, I think banks wouldn't do anything with, they wouldn't lend, they wouldn't, take any sort of risk or anything like that. I just think you see some of these banks where the people involved own a meaningful amount of the bank. And I just really think that's one of the best ways that you can have skin in the game. You come across certain banks where the insiders do own a significant amount. The family may own a good amount. They probably think about risk a little bit different than companies that don't have skin in the game. So I think the paying back the compensation is a bit crazy because I think nobody would go into banking. But I do think as investors, if you're judging a situation and get to choose whether you want to be involved or not involved, a great green flag, if you will, or red flag is, if insiders, the people making these key decisions, don't have any skin in the game. And a green flag would be if they do.
Yeah, that's possible. After the Civil War till the Great Depression, there was double liability in banks for national banks in the U.S. So not only would you lose all the money, the par value of what you had, but you'd also then have to lose everything on top of that, doubling it. So if you founded the bank and put in $1,000, that means that when the bank failed, you'd be liable for $2,000. The $1,000 you put in is lost, plus you have to put in another $1,000. Theoretically, there's a thing with the Federal Reserve that's set up that way, but it's never been used. So that's one thing. Obviously, banks were originally created usually as joint stock companies, and if you remember when Buffett bought American Express, it was an unlimited liability situation. So if American Express failed, Berkshire's partnership and stuff could be liable to pay under those circumstances. It never had converted at the time of the salad oil scandal. That may have given people more confidence in it and stuff. It's true, skin in the game is helpful and stuff, but I think no one intends to drive a bank. When we're not talking about fraud and stuff, they don't intend to drive a bank into the ground. Chorus, which is a huge failure in the last financial crisis, was like completely owned by a family that kept all their stock in it and stuff and did risky things with it. Bear Stearns.
But isn't that enough, you think, losing their entire principal and it being, here we are talking about that years later. Being known for that, good luck starting another bank. Do you think that's enough? Or do you think they should be liable as well for more?
Oh, no, I don't think that the people in Washington and stuff, they're saying this will change any behavior. No, it wouldn't change it. But I also think that people have all the skin in the game that you can and still lose everything. I think that's not uncommon. Yeah. So I don't think that the idea that most banks or most failures in most things is because they know that they'll walk away safe enough and they took these risks. I don't believe as much in moral hazard. I don't think there's strong enough evidence for it outside of economic theory and stuff as much as people think. Like I said, I think risk habituation is a better explanation for what we see in banking, insurance, and all sorts of different economic things, and that makes a lot more sense. So if someone wins, you put your $2 bet down and you win, and then you win again and you win again 20, 30, 40 times in a row, at that point it's no longer a novel risk. And you don't believe that you can lose money doing it, really. You understand intellectually, and you may even have modeling and stuff that's the same as before, but you behave differently. And so that's the issue with asset growth and stuff. As you have something that's a winning bet over and over and over again, eventually then you lose a lot. We talked about the semiconductor stocks, right? For 10 years, they've done great. What will happen is at some point, that will be a winning thing to have done for 10, 15, whatever years. And then by the time most people have piled in, it's going to go down 90%. They're going to lose everything in it. It's because they've been trained over long enough time to always buy the dips and to do things like that. If you've been trained that these loans don't go bad, that this, whatever it is, housing never goes down, you keep doing that up to the point where you lose a lot of money. It's rare for people to start up something, take a lot of risks that no one's ever taken before, and lose a lot of money. Like that's what people are always afraid of. Investors, they think that kind of high risk things are how people will lose a lot of money. Okay, no one's ever made subprime loans, so the first ones ever made are going to be terrible. They're probably not, because no one would do that and they wouldn't grow the assets very fast. Well, what happens is when it gets very seemingly safe to people is when you're at a really high amount of risk. And so winning over and over and over again is what adds to your risk, really. And there are other things that can add to it, but I think that's a very big part of it. So,
so then as an investor, where all you do is sort of look from the outside in and see that they have won a bunch, right, and have done really well, how do you judge that then and get comfortable with that risk?
Well, it depends. I was talking to someone a few years ago. This is before COVID, and they had some Scandinavian real estate things, and I just said, I'm not interested in any Scandinavian real estate related stocks, whether they're building things or whatever they're driven by, because I can look at what interest rates were, what the market has been there from the later 90s through the late 2010s, and there can't be anyone in the industry who doesn't just think it just goes up all the time. Like at this point, I just don't want to be involved in something where it's just been that the interest rate environment and the investment environment just been getting better that whole time, so that no one possibly could see this risk. To see it, you have to study other periods and think that this thing could happen and stuff. You have to find some other examples that aren't the examples of your industry. Whoever thrived in the industry would have just been making the same bet over and over again, which eventually will kill you. But they're doing it because it's always been a one-way return in their lifetime there. It's different if you have these recurrent business cycles, more like you had in, pre-Federal Reserve and stuff, where there would be more people in the industry who would have had experience with making a lot of money, losing a lot of money, whatever, instead of very long cycles. Very long cycles are more of a problem that way. So at some point, even where we talked about like people being hesitant about oil things and those companies not being willing to do a lot of CapEx and stuff, at some point they'll get over that. But the what's keeping that in check and causing not to have bubbles and things is the fact that there was one 10 years ago or whatever, like within recent enough memory. At some point, that isn't the case. So
is that because of prices? Like eventually the price does what it does. And okay, so to your point about people that aren't using their CapEx, right? That creates a supply problem. And so that, if demand is going up, that means prices are going to go up, right? The high prices cure high prices. Well, low prices could cure low prices as well. So does it eventually change because of just supply and demand dynamics and the free market?
I mean, I think recency is a really big issue, and to some extent frequency stuff. There's not a great reason why we should have been a lot less worried about mismatches between assets and liabilities before all of the banks started to fail, and there's not a great reason why we should be all that concerned after. It happened, but you have to be careful with judging that, because even in things that make no sense, people do this. Like literally after we had 3 really bad hurricanes in a row, which is unusual many, many years ago, and some of them for various other reasons because of stuff that happened, also got a lot of play on national news and stuff, especially with Katrina. But with that happening, that becomes something that people honestly start to think that hurricanes are more likely to happen than they are. And they even overlook the fact that then they didn't happen at a really higher than normal rate. Or earthquakes with California, where there was some very famous high profile ones that they remembered, and then people start thinking about that, and then you just go through years where it doesn't happen, and it's as if they think the risk is reduced. It's not reduced in any way. So there are things where like one event does make it more likely that others will happen. Certainly when we're in the midst of the different bank failures, that's true. It's higher and higher probability you'll have a run. Now you can survive a run sometimes. I mean, that is possible if you have access to a lot of other capital and there's a lot of faith in your bank from others who could supply it to you. Within reason, you could survive a run. But that became something that people were very focused on, and then they immediately extrapolate that out to this will never get better and everything. So it's And the reverse is what happens when we saw with the things that happened during the mortgage stuff. And COVID was like that too, with the internet stuff during COVID and everything. Anything that wasn't doing well during the COVID boom, right, it'll just keep getting worse and worse. Everything that was doing well will just keep doing better and better. No one was thinking, oh, Amazon will come out on the other side of COVID worse than it came in. No one could have thought of that idea. Or the companies that don't benefit from the COVID stuff, that are old economy stuff, would be doing even better than they had done before COVID. That was like outside the range of probabilities that they were considering, and yet that can happen. And it's because, how do you sit through investing throughout the whole period and see, some stocks going up all the time and others not? So it's just the frequency and the recency, stuff is very important. And we talk about special situations, for instance. It's one of the reasons why I think most people aren't suited to doing that. At some point, you will have...
Gonna get tagged.
Yeah, but what will happen is you will probably size your bets larger and larger as you invest. And so odds are that you'll have 5 deals in a row to 20 deals in a row work out. Somewhere in that range is pretty likely that you'll have a streak like that pretty much right off the bat. And then you'll lose a lot of money, right? Now, if like Greenblatt, who did this thing that he wrote about, where everything went wrong, the sinkhole thing and all of that, then you might be turned off of it, right? But I mean, it makes no sense to be turned off of it. I mean, it's a funny story.
Yeah.
But if anything, that should make you more likely to invest in stuff because. I
mean, it's just like even people that have lost money in that situation recognize, damn, that's just really bad luck.
It should be that people think that way. Sometimes I hear from people that I wonder if that's true. They should just say, oh, it's really bad luck. But sometimes I think, oh, what was I thinking? The upside was so small. I was greedy with doing this and whatever. I just worry that people, obviously bet on the same thing that's worked for them for a while. That's one of the biggest issues with like trading stuff is in an up market, right? Everything that look, we've had plenty of times where if we sold any stock that was in our portfolio, we'd realize a gain, right? Everything was in a gain position. So now if you had huge portfolios of 100 stocks, that wouldn't be true. Some wouldn't and some would. But that means that every time you sell, you book it in your mind as like a profit. Most people do. A lot of people focus on what was the actual realized profit and whether they were up or down, even if that doesn't make a lot of sense, right? If you held something for 3 years, is it green or red isn't the most important question. You should be dealing with the opportunity cost and stuff of it. But it kind of registers as a gain for them. And then on the other hand, selling something, you register for a loss. When I sold stuff in early 2009, everything would have been in a loss position, right? Everything that I sold to buy something else, they're all losses unless they were very old positions, right? Like anything in the last 2 years is in a loss position in, March of 2009 or something. So that winning constantly thing is a big problem. It's a big problem for banks. It's a big problem for investors in things. And that's much more what I think the risk issue is. If a risk has been around for a while, people no longer perceive that risk as being a big deal. No one rushes into novel situations thinking that it's risky. They're always hesitant to do it. So, but it doesn't necessarily change things a lot. When we talk about, there's no way in which pandemic is more risky now than it was before COVID. It doesn't make sense. It's higher in people's minds and stuff. But also the reverse thing that, people worried a lot about nuclear stuff 40 years ago and don't today. I don't know how much it affects the probabilities that something did or didn't happen for a long number of years. Sometimes it gives you more evidence, to think one way or the other. And sometimes it does affect things that one bank run could make it more likely there's another bank run. But a lot of it doesn't work that way. And most people just think that if they got through something safely, then they're okay with it. So eventually they'll stop worrying about it, So like no one drives over the same bridge every day on their commute and is still worrying about it the 300th time. But everyone has a thought cross their mind the first time they've ever driven across a bridge, right? So that's the issue in a lot of these. And that's the thing that I would worry about with banking and stuff. And if any of these is that that's a very, very big factor.
There's a tropical storm, Brett, that is going to hit Puerto Rico. It's forming, and people are saying that it may turn into a hurricane. And to your point about like the recency thing, and just another example of that. Now the narrative is shifting. Well, this is unusual to have a hurricane at this point in the year, and now the narrative's shifting towards, I'm sure what you could imagine on why that's the case. Global warming, different, sort of things like that. But it's just highly unusual. But I guess people extrapolate that unusualness out as it being the norm going forward. And similar to your point about special situations and all these different things, it's just, you probably should not do that, right? Until there's more of a statistical anomaly there.
Yeah. And, the other thing is like focus on certain stuff. Obviously, with a lot of these, there's always going to be something making an all-time low or all-time high the first time something has happened. It's just a question, that's the problem with the newspapers, right? Like everything is the worst or the best it's ever been in a newspaper because anything that's in the middle just doesn't get reported on. So if you have a terrible hurricane thing, they don't say, oh, by the way, it's the best time ever for earthquakes. They don't talk about earthquakes unless they're having a problem, right? They don't, the loan things are the same way. That we'll talk about, commercial real estate or something, but we haven't had a lot of talk about commercial real estate as the main focus of financial things for like 30 years or something. They talk about residential or energy things or whatever. No one's going to be talking about, all the, that there's lots of other lending that they do that won't be a problem. They'll focus on whatever the problem thing is and say it might be the worst in many, many years or something, which it might be. Yeah. And as we talked about, the other thing with banks and stuff is, for the most part, that I would say is more helpful way of thinking about it, except for ones that are in extreme positions in any one way, it's not something that you necessarily need to worry that much about an extreme outcome. We talked about UMB Financial Bank of Hawaii. If they have a lot of uninsured deposits so that they're in the top, 20%, the top 10%, the top 5% of banks in terms of that ratio, then it's something to focus on and ask, can it fail from this one thing? But I wouldn't necessarily worry a lot about most issues that banks could have unless it's an unusual situation for that bank versus other banks. We just talked about one where the fee income and stuff, or transactional, let's just put it that way, like more one-time things that they'd be getting from two parts of the business was very big. And so it's very different from other banks. So the drop off in that and the boom that I had during COVID makes it totally different from others. But I wouldn't worry about middle of the road things in most respects. You're going, Buffett's talked about that, life breaks you at your weakest link in the chain, right? So it's just that focus on that for a bank is that if the capital levels are really low, that might be a big concern. But if not, it's not the main thing to worry about. It'll probably fail for a reason like the ones we were talking about. If there's a run on the uninsured deposits and stuff, it's not necessarily a formula to put all those things together. I think is important to keep in mind. So it's, like I said, we talked about a few situations where people had a lot of skin in the game and then they still failed, right? And we talked about, I've talked about how lots of times banks will have very high capital ratios and they're the ones that fail because insufficient capital wasn't what killed them. The banks that you saw failed because they were in the worst position for that type of risk that is the risk that happened. It's also reasonable to say that in 9 other ways out of 10, they might have been running the bank very safely, and they could argue that. But they were unsafe in a way that's the risk that materialized. So you could, on average, be pretty safe or not very safe, and yet have an outcome that's different because the one factor that mattered is what it turned out to be. So I would just say, focus on that. What is the one particular risk that could happen to this bank or something, and not just like a general overall how safe is this or how not safe. Because I noticed that's the thing that gets overlooked is like someone really likes this bank or whatever because they think it's really safe in this way, which it may be, but it has this one aspect to it that's very unsafe. So it could be asset liability mismatch. It could be that the reserves are really low. It could be the asset growth, like we're talking about, is very high in something. It could be all sorts of different things like that. But if it looks like a middle of the road bank in all ways, it's not going to be very risky. There's going to be something that's out of sync in which it ranks very high out there on the risk taking. And that's kind of what matters more, is the relative position of that for people to focus on. Because there was a point where I was getting emails from people that was just like, any bank that relied on deposits and stuff, so regional banks and things like that, anything that wasn't too big to fail, they wanted to know if it was going to fail, and
at risk,
and I shouldn't invest in it, and maybe, but it would probably be the 2000th one to fail, or the 200th one. I mean, how many do you expect to fail that way? If we rank them in order, this isn't the one to be concerned about. And then there are others that it is the one to be concerned about. But it's just like you take that entire group and think that it's going to randomly happen to them, which it wouldn't. It would really happen in an order that has to do with the riskiness that they have. And it's usually easier to rank order things about what their riskiness is and what their exposure is than it is to come up with any calculation. Because thousands of banks did fail in the Great Depression or something. So yes, it could happen. But, if the first ones to fail would be easier to spot than the ones that would fail much later. You probably could never imagine that they would.
Yeah, but you've made a good point about stuff like this before. In the future, the history books will just talk about First Republic, Silicon Valley Bank, and perhaps Silvergate, maybe not. It'll really talk about those three banks, right? Where it probably won't talk about all these other banks that have, been grouped in with those banks failing, even though they haven't failed, right? We're just living through it in real time. So it's a little bit more scarier, but 10, 20, 30, 40 years from now, people doing case studies will just probably study really First Republic and Silicon Valley Bank.
Yeah, and they won't talk about, in fact, some people might say, why did they think that all these other banks would be at risk or something just because these few failed?
What a great buying opportunity.
Mm-hmm.
Yeah. Uh-huh. Okay, so next company that we spoke about, HMN Financial. We profiled it at $13.58 per share. Price today is $19. Let's see what you thought. Geoff, you thought that they had terrible performance 10 years ago, and it got better over time. It didn't strike you as particularly safe. But you just thought it was a typical bank. Price to book in 2020 was 0.7 when we spoke about this bank, and it's 0.8 today. So you just thought it was a typical bank trading under book value.
Yeah, and I think this is right. I hope I'm not wrong there. Oh, let's see. All right. Because let's see. No, not really. There's a little. Yeah, I don't want to talk about. I won't mention that. It is exactly what we just said, basically, right? I mean, you summed up exactly what it is, and I don't see much of a difference to today versus that. Yeah.
Mediocre return on equity.
I haven't seen much of a change.
Grows.
Yeah.
Barely.
Since COVID, I haven't seen much of a change of any of the things that we talked about.
All right, next one. SMBC. Southern Missouri Bancorp. Talked about it at $23 a share. As you can see, it's at $42.38 per share. Price to book in 2020, 0.9. It is at 1.1 today. Return on equity is the same today as it was in 2020. You were much more optimistic about this one. You had thought that it was much more predictable. You liked the stable returns on assets. You had said, and I quote, over the last 20 years, this stock basically justifies a price. So I'm not going to quote you. I'm going to generalize. It justifies a price to be trading above book value. So as I said, it was at 0.9 times then. Now we're at 1.1. You liked the business, thought it was predictable. You liked the growth at the company, and you had thought that it justified a higher multiple.
Yeah. I guess again, you can see. So this bank did actually decline in its stock in relation to the like period where some banks were failing. It did come down a bunch there, but overall, this falls in the same category as like the Axos stuff that we're talking about. I think probably it's just something that is a bank that people wouldn't be that concerned about because it has high loans to deposits and stability and things versus the banks that had more in the way of securities and stuff is my guess. But so I'm not going to say I'm as positive on this or Axos as the market part of it kind of implies, because I think that some of that is purely a reaction to the fact that things went into loans instead of deposits. Yeah. Looking at their stuff since COVID, I think that's really why the market has probably been not as bad for this as some other things, just like what we're talking about with Axos. It had a big inflow of deposits and stuff, but it loaned it out. I don't know if that's great. I don't know if I agree as much with that. I do think that the market is kind of, we talked about focusing on uninsured deposits, and so we've mentioned a couple of banks with that, but it just seems they're really focusing on uninsured deposits and on mark to market, on losses in the marketable securities, whether they're held to maturity is a big focus of it. This bank didn't have a big increase in securities from when it had a big inflow in deposits. I mean, a bank could have just taken a lot of money and made a lot of bad loans, but it seems like the market doesn't worry as much about it taking a lot of bad loans or just long-term loans and things as buying a lot of bad securities. So I don't want to be negative on either Axos or this one, but I just feel like probably the optimism about them is just because if these were all securities instead of all loans, I don't know that people would be as positive. It's just not the thing the market's focused on right now.
And then the last one that we had spoken about in that video, Hingham Institution for Savings, ticker HIFS. We've written about it on the website and spoken about it a few times on the podcast. Talked about it at $184 a share. Price today is $215 a share, but it did run to more than $400 a share and then came back. Yeah, looks like the high was 420. There you go, Elon Musk. Any thoughts on Hingham? People obviously ask about HIFS often. We haven't given an update on it. What are your thoughts?
Yeah, I think the market is more positive on it again because, it's down a huge amount and stuff, but more positive over the full period we're talking about. And certainly since it's almost not that far from prices that it was at around the time that that different banks started failing and stuff. So again, I think it's loans versus securities. If they had the same duration stuff and whatever, but which is hard to say what the duration is on the mortgage stuff, to be honest. But if they had the same mismatch between short-term liabilities and long-term short-term liabilities and long-term assets, that was all in securities, I think the market would be much more worried about this. But we'll see. I think there's some people who would like this better, say, than Bank of Hawaii or UMB or something, but I think it's heavily mismatched. Now, when rates start to come down, when they start cutting interest rates, that would be a big positive. But you're using marginal deposits for all of this stuff. As you can see, loans to deposits are often over 100% or something, or at 100%, and you're paying fair amounts of interest and stuff on them to get those deposits. So I just think that if we're going to say relatively, now, if rates come down fast and whatever, the stock could do very well, quickly in anticipation of results. But maybe there's too much attention being paid to concerns at places like Bank of Hawaii and UMB and not enough at Hingham relative to each other. Any of them could do really well. Any of them could do really badly. And they're all sort of in categories where they're not the safest banks in the world. They're not the easiest to predict or something, but they're also not the absolute worst in some ways either. There are cases, all three of those banks, I'd say, where you could make an argument for some things that are positive and some things that are negative. the easy argument for Hingham is that it's just an issue of the inversion and stuff, and that you have that fixed as soon as that stops, right? That's the only problem that they have. However, to be fair, this Bank of Hawaii and UMB is okay. Well, they don't have a problem as long as people aren't pulling deposits. If they stop being bank runs, then they don't have problems either. So yield curve inversions are very rare under modern monetary policy since the 1970 or so, when the U.S. really completely went off like Bretton Woods and stuff, and it had gone off the gold standard, a few decades before that, in the 30s. They're not as unusual under any other monetary circumstances. So I would caution that. It's not like yield curve inversions are some unnatural thing as much as we might think. It's very likely that they're like that in part because of Federal Reserve policy and stuff. And maybe the fact that we had so few inversions in the past that didn't last long enough is the reason why we have such a big inversion now that is lasting so long.
Yeah. Here's a 20-year chart on yield curves. And this has been definitely one of the longer inversions. If not, is it the longest or what?
Yeah, it's basically the yeah. I mean, in terms of duration, this is going to be the worst. Yeah, I mean, in terms of sharpness, there might, depending on which part of the curve you pick and stuff. I mean, maybe when the Fed stopped using the Fed funds rate and used money supply targeting and stuff under Volcker, maybe there was something that was deeper. I don't know, but yeah. So Hingham is a super efficient bank. And so it can afford to pay higher rates of interest and to charge less on loans and stuff. It also has very, very few loans go bad. So with almost no loan losses and with very low expenses, you make a lot of money by borrowing short and lending long, and taking advantage of that curve. And as soon as that curve on inverts, then you make a lot of money after that. So it's a popular stock and stuff. People talk to me about it and everything among value investors. You can look at the yield curve inversion back in around like the 2007 type period. Their results dipped in 2006, 2007, and then improved in 2008. And that would be the last time that there was an inversion like this. So this is obviously much worse, but that would be the place that you would look for that. It has really good results over a very long period of time, compounds very well. Management is very value investors, very Warren Buffett type thinking in terms of how they think about capital allocation and all that kind of stuff. So it's a very popular stock with people in this school of thought and stuff, of the kind of people who listen to our podcast. I'd say it's very different for that reason as a stock from any of the other ones we talked about. It has a very good long-term performance, as you're showing there. So it's compounded at a very good rate for decades. Same family's run it for like 30 years. So it has a very good record that way, but it's a very, very different kind of stock. It attracts a following from specific people who like it and may invest in it and only it as a bank stock. The other ones we talked about, people are likely to buy when they're cheap and then sell when they get a little more expensive. This is much more of a compounder, people focusing on it for that reason. And so I think the dynamics of the stock could be very different.
Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focused Compounding Podcast. If this is the first time you are joining us, be sure to hit the subscribe button and check out all of our content on the internet. Best place to do that is to follow me on Twitter at @FocusedCompound. And you could go to www.focusedcompounding.com to get access to investment write-ups from Geoff going all the way back to 2005. If you're interested in learning about our money management services, you can reach out to me directly at andrew@focusedcompound.com, or you can go to the Invest With Us tab on our website and get more information on that. I want to thank everybody so much for all the support. Thank you so much for tuning in, and we will see you in the next podcast. Take care.